This show is produced by the Hartman Media Company. For more information and links to all our great podcasts, visit hartmanmedia.com.
Welcome to the AIPIS show for accredited income property investment specialists and those who aspire to be. If you're a real estate, mortgage, or financial professional, this is the place for you. We'll explore innovative investment analysis, sales, marketing, and income-generating strategies for the most historically proven wealth creator, income property. Learn from the experts as they show you how to build a better business and a better life.
It's my pleasure to welcome Marc Biron to the show. He is founder and CEO of Diversification Corp. This is an interesting product, maybe a totally new idea. We'll see what he says about that helps homeowners diversify their market risk, their market exposure in their own home investment. Marc, welcome. How are you?
Very good. Thank you, Jason. How are you?
Good. Interesting product you have here. Where are you located?
Manchester, New Hampshire.
First question, is this strictly for homeowners or for homeowners and investors?
Well, we're taking investment right now, but the product is strictly for homeowners.
Okay, so what the product does, I know one sort of component of it, if you will, is basically a mortgage product. Not really, but sort of. It sits as a second mortgage. And this second mortgage on a home, or a first mortgage, I guess, if they own the property free and clear, can diversify market risk, right? How does it do that?
Yes. What it does is we use home price index technology. We basically swap the local home price index, the changes in the local home price index for the homeowners to the national diversified home price index, which is 42% more stable. And so what that does is it improves the credit profile of the borrower, where they can get substantially better terms on their first mortgage. And it also reduces their exposure to the local market risk, which reduces their foreclosure risk by, on average, 40%, and protects their home equity. You know, home equity, typically they use for many different things, primarily for their primary retirement asset. So it protects that. And even, during the life, it, protects the home equity for such things as paying for your daughter's wedding, for example.
There you go. This is a pretty interesting and unique product. Is there anything else like it, or where do you get the idea? Where did this come from?
There is nothing else like it. This is totally new, nothing else like it. There are shared appreciation mortgage type products, which transfer risk, and there's a few new ones that are popping up that transfer risk, but our product really reduces risk through diversification. A little bit of a story as to how it came about. It's really, I guess you would call us a 20-year-old startup. I authored an article back then trying to solve the problem for a bank I was working at to diversify their exposure from local to national. But then I thought, well, boy, this would make sense for mortgages, for homes especially. But the technology wasn't well defined yet for the home price index technology, and now it is. And so for the last 3 years, we've been building this out, and we intend to disrupt the nation's largest markets, housing and housing finance.
Fascinating. Now, right at the outset, you said that the national market was, I think, 42% more stable than a given homeowner's local market. Of course, I need to ask you, compared to what? I mean, if you're in, now we, just so you know, just for a little background, our listeners know this, but we divide markets into three major types: linear markets, cyclical markets, and hybrid markets. And the cyclical markets are the ones that get most of the attention. They're about 75% of the 20 markets in the Case-Shiller index, and I think that index is extremely misleading because of it. They're the markets that get all the news. They're the west coast of the U.S., the expensive northeastern markets, and, South Florida. Okay, all of these sort of hot markets. But those markets have bigger cycles, much more significant. In downturns, they hurt the most. In upturns in the market, they do the best. in terms of the appreciation cycles, versus the linear markets, which is the vast majority of the country, that just kind of chug along. They have small ups and downs, but they're not hugely significant. So when you say 42% more stable, you must be talking about the cyclical markets, I'm guessing.
No, I'm talking about average.
Okay.
So you make a good point, Jason. Some markets have historically been more cyclical. And yes, we've seen the same thing exactly with the markets, the West Coast in the expensive markets where they get hot and then they get cold.
Yeah.
Now, who knows? But, it happens in Vegas. It happens in the Sand States. But
yeah, so like Vegas and Phoenix, just so you know. Yeah. Okay, go ahead.
Pardon me?
Yeah. Well, I was just going to say, just to point out, because I didn't give you an example of hybrid markets.
Yep.
Phoenix and Las Vegas, along with Denver, maybe Atlanta, maybe Dallas now, a few others, Austin, would be hybrid markets, kind of in between the two. So go ahead with what you're saying. Yeah.
Okay, so the 42% more stable is just looking at the average volatility of all of the zip codes in the Zillow database, looking at the average volatility versus the volatility of the average volatility of the zip code local home price indices, historical volatility versus the volatility of the national home price index.
To compare it to the stock market, you'd be the VIX, right? When we talk about volatility, we're talking about the VIX index, right? Which is the volatility index. You're saying that any given local market is much riskier than the national market because through the law of large numbers, it just evens out statistically, right? And okay.
So we like to use the example that this is like, instead of owning all your investments in one stock, whether it's Amazon or whatever stock.
You got the S&P 500.
You got the S&P 500.
Right. Got it.
So why can't you? So the question is, why can't you diversify your largest asset, right? Well, now you can.
Very good point. Okay, so tell us how it works. A consumer gets a mortgage on a property, and you probably have set up deals and relationships with banks and mortgage brokers, and they offer this as sort of like an insurance policy, but it's not really insurance, right? What is it?
It's like insurance. I mean, it gives peace of mind, and it's very cheap insurance. For an average home, it's $18 a month. And, what you get is peace of mind that, your home equity is protected and your foreclosure risk is significantly reduced. Really a fantastic deal. Almost sounds too good to be true, but it's because of diversification benefit, which has been called the only free lunch in economics. But okay, that said, how it works is we're looking at the largest originator, but they will be advertising, hopefully, this product. A consumer goes in, applies for the product. It's a home diversified mortgage. And they, execute the first mortgage along with the addendum second lien. And the first mortgage becomes, because of the reduced risk that we've been talking about, the first mortgage becomes much less riskier to the creditor, allowing for better credit terms, higher loan to values, lower down payments without PMI. Kind of amazing.
Well, it's without PMI at a above 80% loan to value ratio. Is that what you're saying?
Yes.
Okay.
But that's still to be done. That's at least 12, just to be clear, that's
a goal. It's not today. Yeah. Okay. Got it.
Yeah.
All right. Keep going.
So that's it. The first mortgage gets funded in the ordinary way. Just Fannie Mae and Freddie Mac will buy the mortgage and do their thing, package it and securitize it. And the consumer gets what they get for, like I said, $18 a month.
But what is it? We still don't know what it is. Like, I don't understand what this really is. It's a financial product. It's a second mortgage. Let's look at a real deal.
Sure.
Okay.
Sure.
I should say a hypothetical deal, but let's get down to the nitty gritty mechanics. So just for round numbers, someone buys $100,000 house. Now, I know you can't do that in very many places, but it's round numbers. So let's make it easy. They buy a $100,000 house. They want to get a 90% loan to value. So they're going to borrow $90,000. They're going to put down $10,000. And with your product, not yet, but in the near future, hopefully, they can get that mortgage above 80% loan to value without having PMI or mortgage insurance, right?
At the same interest rate.
Okay, fantastic.
As if it were 80%.
Sounds good to me. So then their property also has a second mortgage on it too? That's your product?
It's technically a second lien, but same thing, right?
Okay.
Really, as they will see it, as one combined product. It's really a first mortgage with an addendum.
Okay, but how much is that second lien for? If there's a second lien, it must have an amount of money on it, right?
It does not. It starts with a zero balance, and the balance will fluctuate positive or negative.
Okay, so they've got this second mortgage on their property, but it's for zero balance, right?
Yes.
Okay, and then what happens? They own the home, and it's a year or two in the deal after they've funded this mortgage. Then what happens?
What happens is at the sale of the home, their positive or negative balance will be settled at the sale of the home.
Okay, so let's say 5 years have gone by. Yes. They're selling the property, and
so there's
the
no
index. Yeah, there's no payments
sure.
on this second mortgage that's there.
Yeah.
It's like a sleeping second. It has no balance, no payments, right? But then that second mortgage, that second lien is tracking the index, I'm guessing, all this time, the last 5 years?
The second lien is tracking the difference between the local zip code home price index changes versus the national home price index changes.
Okay, so let's take an example. So say that the local market, on average, over 5 years, did 3% appreciation, but the national market did 6% appreciation. What happens at the sale of the property?
At the settlement table, we, Home Diversification Corp, will cut a check for 3%. So in this case, for $3,000.
Oh, that's
now
good.
the opposite is true.
Yeah, right, sure.
Yes.
Okay. So if they lost money, if the local market did 6% and the national market only did 3%, then the second mortgage is suddenly going to have a balance, I'm guessing, that will require a payoff before closing, right?
Yes. So at the closing table, we will get a check from closing for that 3% for the $3,000. I mean, the good news to the homeowner is that they outperformed the national.
Okay.
You know what I mean? So that's the good news, but 3% will come out at closing. It essentially locks them into the national.
Interesting.
Yeah.
So you mentioned a lot early in the interview about the technology of home price indices. It wasn't really developed enough for you to do this in the past. Talk to us about the indexes. You say there's, I think, 6 major indices, right?
6 major home price index data providers.
Okay.
And we have one locked in place. We've selected them, and it's the best. And I'll just say it, it's Zillow.
Okay.
And the reason Zillow is the best, well, first they claim that they're the most accurate, and I've read their economic data, and I believe it. But a
lot of real estate agents and buyers and sellers will argue with that, but go ahead. Yeah.
Not necessarily at the home level.
Right. At the national level, they law large numbers.
But at the zip code and the national level.
Okay, fair enough.
Relative to their competitors.
Mm-hmm.
But what makes it, I think, the best for consumers is that it does have the brand name. So, it is Zillow, and like you mentioned, people can dispute their home valuation, but it does have, a strong consumer brand. And I think most importantly is that their data is published and it's updated monthly. It's just a very large data set going back, I think, 15 years or something like that. So consumers
we have to remember that Zillow is a pretty new company in relative terms. I mean, look, I've been in business longer than Zillow. Okay. But go ahead. Yeah. I mean, it's not 100-year-old. It's not the Dow Jones Industrial Average. Okay. Yeah. But go ahead.
But no, we have backups. If something ever were to happen to Zillow, we have backups. Like if Zillow were to ever disappear, we have backups. But what I think is an important point, what I should say is we think is an important point to the consumer, is it takes our methodology out of the black box, and that they could actually go to the Zillow website and see the home price changes and the actual values in their, local zip code market. And so we think that's a compelling advantage that Zillow offers over their competitors.
Okay. So talk to us more about the index, though. Like, how was the technology not there before and it's there now? And the accuracy of it, how it's compiled, just anything you want to say about that, because I think that's going to be a big question people have.
Yes, I will say that when I first looked at this 20 years ago, the only thing that was available were, I think, 10 Case-Shiller indices of the top 10 metros. And so it really didn't solve the problem. And since then, I don't know exactly when, but since then, they've gone down to the zip code level with fairly accurate. I could get into the statistics, but fairly accurate. But of course, your home price can do better or worse than, the local zip code performance, and it will do better or worse. And a lot of that is up to the homeowner, whether they over-maintain, under-maintain, add additions, buy right, sell right. Because our methodology is not on the specific home, but is on the local zip code index, all of the, pluses and minuses that belong to the homeowner, additions or under maintenance, they own. This is just strictly based on the performance of the local home price index.
Okay. Mark, I'm really glad you mentioned that, because that is a huge question mark here, right? It's maybe a potential point of dispute. So let's take that example, that $100,000 house with a $90,000 first mortgage when they bought it. They've got your product in place there. They're selling it 5 years later, but in the meantime, over that 5 years, they've installed, beautiful wood shutters, they remodeled a bathroom, and that increased the value of the house. What do you do about that? On either side.
That's the important point is they keep any benefit, any value over the home price index, they keep when they sell the house, because the contract is only based on how well the local home price index performs relative to national. So in your case, if it's a $100,000 home and local underperforms national by 3%, well, then, they owe that money. But if they put in $20,000 worth of additions that they get value at on the sale of the home, that all goes to them.
How do you attribute and allocate that value of those improvements, though?
Okay, so let's give the specific example. $100,000 home. The national increases by 3%. The local increases by 6%. All they owe us is at the closing, from the closing table, it's $3,000 to us. But they've outperformed the national. Now, if they sell their house for $120,000, that all goes to them. They will just have to pay us $3,000. And so if they sell their house for whatever they sell it for, either through a good sale or they've added all the nice improvements that you mentioned, they keep all that added value.
Okay.
They get it from the sale of the home. We don't take any of that. They just owe the $3,000.
Right, but it kind of depends which way that deal goes, right? If they outperform the national or if the national outperforms the local, right? Doesn't it depend which way that goes as to how that would settle? Same
thing. If they outperform the local, all of that outperformance will go to them, either if they overperform or underperform. Mm-hmm. Now, of course, the opposite is true. If they don't maintain their property, or if they sell wrong or something that's mostly in their control, then they will, sell for less than their local zip code change, and it'll cost them. They'll lose money because of that.
Yeah, interesting. What else do you want people to know about this? What's kind of interesting in the broad picture is where this is going, right? Where everybody's property is becoming like a financial asset, that they'll actually watch the way people watch the stock market almost. Of course, it's not that volatile. The stock market's far more volatile. But they'll be watching the National Home Price Index to see, hey, we should feel good. I guess they should feel good, right? Because it's better than their local market. Or they'll be watching it compared to the local market and thinking, it really changes people's thinking.
Yes, I would say that's exactly right. Of course, there are many. The meltdown wasn't so long ago, and people got hit hard. Mm-hmm. We offer some protection, like I said, very, very inexpensively. But yes, they will be paying more attention. I agree 100%. They'll be paying more attention to their local market performance and their national market performance.
All right. Good stuff. Anything else you want to say before you go? Give out your website.
Oh, the website is www.homediversification.com.
All right, Marc. Thanks for joining us.
Thank you very much, Jason. I appreciate it.
Thank you so much for listening. Please be sure to subscribe so that you don't miss any episodes. Be sure to check out the show's specific website and our general website, hartmanmedia.com, for appropriate disclaimers and terms of service. Remember that guest opinions are their own, and if you require specific legal or tax advice or advice in any other specialized area, please consult an appropriate professional. And we also very much appreciate you reviewing the show. Please go to iTunes or Stitcher Radio or whatever platform you're using and write a review for the show. We would very much appreciate that. And be sure to make it official and subscribe so you do not miss any episodes. We look forward to seeing you on the next episode.